Okay, trivia time. Time is on the clock. Name 5 things that automatically come to mind when thinking about wealth management or financial advisors. Ready? Go.
That's easy. Bored, painful, rather listen to my in-laws, numbers.
Almost there.
Torture?
We have a winner. Let's tell him what he's won. You've won the PennyWise Financial Podcast. Yes, it's a financial show, but we talk to you like human beings talk. Sure, we do the traditional retirement planning and money management, but we also help plan for other decisions, like buying a car, selling a home, buying vacation properties, or selling a business. We're more than financial advisors to you. PennyWise Financial, brought to you by Monarch Wealth Management. This is PennyWise Financial, and this is Constantine Kitrinos and David Georgiev.
Morning, everyone. Constantine here, PennyWise Financial.
Dave Georgiev, Monarch Wealth Management, and we have a wonderful guest with us today, Matthew Merrick, who's coming in from Haus Capital. Good morning, Matt.
Good morning, Dave. Good morning, Cons. How are you guys today? Thank you for having me.
Thank you.
So what's going on, Matt? Well, first of all, I guess before we dive into some real questions, can you give us a brief synopsis of who you are, what you do, where you do it, and kind of just a little bit of background about yourself?
Yeah, sure. Thanks, Dave. So as I was introduced, my name is Matthew Merrick. I'm a mortgage loan originator with Haus Capital Corp. Currently, I have about 10 years of experience in banking in the financial systems, starting all the way back in 2010 and working my way up through the banking systems and eventually getting into my role as a mortgage loan officer at a local credit union here, Exceed Financial Credit Union. Wanted my kind of career to grow, and I took an opportunity at a local mortgage broker down here at Park Avenue in the city of Rochester, and it's just been really good for my career. I've learned so much. The broker world is super cool, and it just taught me so much and opened up a lot of doors for me. So I'm really happy where I'm at, and that's a little bit about me. So
awesome. Well, cool, Matt. And I do I do have to say, when I met with you and your wife here a couple of weeks ago, Matt was just kind of talking about his pipeline and his industry and stuff. And from knowing Matt, I've known you. How long have we known each other? Probably
at least 5-6 years, maybe longer.
I was thinking 5-6 years, absolutely. But right around that time. So from 6 years ago, listening to Matt talk about mortgages and just the industry as a whole, compared to sitting at in our conference room talking, and he's just spitting out this, mortgage talk, I guess, for lack of better terms. I'm just like, wow, like you've come a long way.
I'm a mature. It's like I've matured. I'm a mature kid now, mature person.
Well, it's like a practice, right? Even in financial services, wealth management, financial planning, Dave Georgiev investing for my clients at 27 versus Dave Georgiev at almost 40 investing for my clients. It's a whole different person. It's a whole different philosophy. And I think the same has been for you, Matt.
Absolutely. I think experience is probably, one of the biggest tools in my tool belt. And, every day that goes on, every scenario that I come across, not one, probably like investing, not one investment strategy is the same for everyone else. And that's the same for, that's the same for mortgages. I mean, we have the product to work with, but not, every transaction, every scenario is different. We learn things. Underwriting is always changing on the fly. There's a lot going on right now, which we'll probably get into later, but I mean, it's really changed the scope of the industry, and, but it's all exciting and it's all worth it.
For sure.
I've got 2 questions for you, Matt. First question, I think I kind of heard it. How do you pronounce the company? Is it Haus? And part 2, what's so different about what you're doing there than in the past with other banks in the bank programs, like as far as your offerings?
Sure. So it's pronounced Haus Capital Corp. My president and broker owner, I don't know, maybe like German beer, so he wanted to use Haus, Haus, just spelled it a different way, or maybe it was a little bit unique, or I don't know, maybe New York State Department of Financial Services didn't have Haus, Hause, Capital Corp available. I mean,
Sure. I like it better. I like it better.
So it rings. I think it has an actually cooler look to it if you're like looking it on paper. So it's Haus Capital Corp. We're a local mortgage broker shop, and I would say the biggest difference is we have a bunch of different lenders that we can use that are available to us instead of just using one specific bank's or one specific lender's guidelines. All lenders really underwrite to the guidelines of the program that the loan is for. So there's conventional, FHA, USDA. You guys are familiar with hearing with these products, and I'm sure a lot of the people in the audience are well, but there's a set of guidelines that are set out or put out by each one of these agencies, and all these lenders are basically taking a look at what they're putting out and applying those guidelines to the borrower, because at the end of the day, these lenders want to sell their loans. So different banks have different, we call risk criteria or overlays. So if, for example, right now, I'm not picking on Chase. I like Chase, but right now Chase just came out and said that they're not doing any loans right now unless you have a 700 credit score or you're 20% down. That is a Chase overlay right now for what's going on in the environment. That has not. They do originate conventional loans, all these other loans, but right now you need to fit that criteria in order for them to do a loan for you. And that has nothing to do with the guidelines that they're selling these loans to Freddie Mac or Fannie Mae. That is a Chase guideline. So if you're a Chase customer and you want to do business with Chase and you don't have a 700 credit score and you don't have 20% to put down on your house, they're not doing the loan for you. So working with a local mortgage broker like myself, as these lenders are changing on the fly, I have a dozen of them with all different risk criteria, some very lenient and some very strict. So the majority of the time, we will always have a product or program that will work for our borrower. Does that make sense?
It does. Actually, I mean, so you're not corralled into this small product set. You basically can look at each person individually and look at their situation, credit score, needs, amount of money down, what programs that might qualify, and you could find the best lender for that individual.
Correct. That's what I spend a lot of my time doing, actually. So that's exactly what we do here.
Honestly, that sounds like a win-win. With that, let's take a quick pause and we'll be right back with the show. Looking to buy or refinance a home? Work with a local broker who can shop for your best option. At Haus Capital, their mission is to provide exceptional customer service with a superior experience. They're flexible and innovative so they can customize a solution that's right for you. Contact Matt Merrick at 585-461-5656, extension 112, or visit hauscapitalcorp.com. That's Haus Capital, where Matt has a strong commitment to home ownership and making the American dream come true.
Welcome back to the show, everyone. Dave Georgiev here with Constantine Kitrinos and our guest of the day, Matthew Merrick from Haus Capital. What we kind of wanted to talk about now was, Matt, specifically being in the mortgage business, what are people doing now through this COVID epidemic, pandemic? I want to say we're on the tail end of it, even though I think it's still going to continue for a while as we slowly open up this economy. But what are you seeing out there? Like, how does it work with getting pre-approved for mortgages? Even just on the real estate side, the realty side of how are people even able to see homes with realtors and all of that stuff? So can you kind of dive into that and kind of give us an update?
Yeah, sure, Dave. I'll do so it seems kind of like a two-part question. So I'll do my best to answer the real estate side or the realtor side, even though that I'm not as adverse to knowledge in exactly what New York State law says right now. They are are and are not allowed to do. And then I'll see if I can better answer, better prepare if you're a home buyer now. What are you doing if you want to buy a house right now? So
Sure.
the first question is, if you're a realtor, how are you conducting business? It seems like, or how are you showing houses? From my experience and everyone that I've talked to right now, we're playing in a different ballpark. It's a different playing field right now than anyone has ever really experienced in the industry. So they're learning and they're adapting and they're trying new things as we go. But right now, realtors are not allowed to go with their borrowers to show houses anymore. And this is the first time it's been like that. There's always been people with the caveats of virtual tours if you can't do that, but this is now the norm. If you're a seller right now and you are taking your liability and your risk and you're allowing the borrower potentially or buyers to come in and look at your house, because what's happening is these real estate companies don't want the liability, so they are not allowing their agents to show a house at all right now. So if I'm sick and I don't know it and I'm Howard Hanna and I bring my buyer to the house and they infect somebody, then there could be a potential, I don't know, lawsuit. Someone could get sick. It could go. So they want no liability. They're taking the step out of it. They're still writing contracts for their buyers. They're still coaching their buyers, setting up other referral partners throughout the process for their buyers. But from my experience, they have very little hands-on as far as what I would say that their main responsibility is to do, to go through and walk through the houses and point things out. Talk value, negotiate as they're going through. That's just what I've been seeing. So they've been getting around it. They've been very creative. They're doing things with virtual tours and pictures and FaceTime calls with their borrowers. But I mean, it's a completely different industry right now. So there's that. I don't know if I was able to answer that as specific as you'd like, but that's just from what I'm hearing. And then if I'm a buyer right now, what is the scope of the industry like for me? So things have changed a lot, whereas I would say 2 months ago, the impact of COVID-19 hasn't made the lenders change any of their loan programs or add these overlays like I had mentioned in the previous segment. But due to COVID-19, every lender is changing, I would say, at least weekly and adapting. So there's new overlays, there's new additional layers of risk that the lenders have put on their loan programs that weren't there before, and it's making it more difficult and more challenging as a buyer to get into a house. For example, government programs, FHA, USDA, VA. We saw a massive change in the minimum required credit score that they were accepting. They're no longer taking expanded debt to income ratios, things that they were using to qualify buyers before, such as rental income. That stuff is all seized right now. They don't want any additional risk. They're taking it really hard on the chin right now, and they're reacting due to the recent number of early payoffs when there was that quick refinance boom, towards the middle of end of February. And then, they're getting slammed right now with a whole bunch of first payment defaults, and they're reacting to that. There's a lot of people that just originated or bought a home in the last, even go 6-12 months out. And, we have, your governor's coming out and saying, don't make your mortgage payment. This is very challenging if you're a bank, because they're going to come up with ways how to comply with that. They're going to help their borrowers if they're financially challenged. But first payment defaults and the amount that the industry is seeing in the last 60 days has really sent some of these banks into hold the phone here. I've seen recently some of these lenders actually close up shop. we lost two of our broker, two of the banks that we broker with, just because the financial losses were just too hard. They're still on the hook to make payments under the contracts when they sell to the secondary markets or their investors. So, just because we're not making the mortgage payments, well, HUD or Fannie Mae or Freddie Mac or the investor, their payment's still required to them. So they don't want any more risk. So that being said, they've increased FICO scores. They've just changed requirements on all programs right now. And I remember in 2008, I was just a young kid, but looking back now, it made me take a step back and look how lending changed back then and how long it took to come out of it. I mean, we didn't really see things come back to normal till 2013, 2014. There's no more non-QM products anymore. The cool stuff that we were just getting start to see, like bank statement program as a business owner with less than 1 year of tax returns, caveat, loan to value, investment product programs that some banks would have. All these things are gone right now. So it's really like we're back to, the straight and narrow. FHA, it's 660 now at most places, 640, 660, somewhere around there. 2 months ago, I have to get specific, but I originated a 583 FICO score, no problem. Do you approve eligible? We sent it through. Can't do a 583 right now.
Yeah.
Can't do up to 55% back end ratio right now. So, it's challenging, but they really just don't want anyone with any extra layers of risk right now. So, we have some more options than a lot of the local, brick and mortar places in Rochester, New York, because of our broker channel and broker affiliates. There's still some banks out there that are taking the risk, but for the most part, they've all buttoned up.
I got a question for you. Dave, we talked about this a few times, and you mentioned Chase, not to pick on them again, but Jim Cramer.
I'm really not picking on
No. I get it.
I'll pick on him,
but Jim Cramer actually got declined from Chase on a mortgage, and he's a wealthy man. He could probably pay cash for whatever he's trying to do. I think he was refinancing, but I have a question for you. So let's say there's somebody that was an exec at a company, great job, good tenure, and all of a sudden they're laid off because of COVID and they're coming to closing. Can they still close? Are mortgage lenders still allowing that to go through?
No. They'll suspend the loan until, I had two happen to me. Actually, that's a really good question, Constantine. Really good question. I had two loans in process that happened through this where the borrowers were furloughed. The company's still saying that they're an employee, but they're just not collecting a paycheck right now. And what's happening is, due to COVID, banks are changing the way that they're doing their verification of employments. It used to just be 10 day prior to close, verification of employment need to be done. Okay, no big deal. Then they'll do a verbal that morning, and then within 24 hours, and you close. Now they're doing verification of employments no greater than 48 hours prior to closing. So the 10-day is out the door. So they will know whether or not you are employed, and if you're collecting a paycheck. If you're not collecting a paycheck, they will not close your loan. They can hold it. They'll suspend it. They're willing to work with you if you're on furlough, but you have to be employed to close on your home. If you're very wealthy, they're very, very wealthy. There's ways that you could probably still close using annuitization of assets or something like that. But that's a far stretch. No one really wants to do that. They're not closing your loan. You're waiting. You're on furlough, and the banks will know whether or not you're employed. So the answer to your question is no. You can't close your loan right now.
Good answer. With that, let's take a quick break and we'll come back with the last segment of the show.
This is PennyWise Financial, and this is Constantine Kitrinos and David Georgiev.
All right, welcome back to the third segment of PennyWise Financial. Our guest host, Matt Merrick from Haus Capital. And we just talked about the loan process and how some of those folks that might be unemployed now started the loan process months ago. It's creating a backlog. But let's talk a little bit more about the effect on interest rates. The Fed, I mean, we're near zero and probably going to be there for a while. How does that affect the rate that people will pay on their mortgages if they're buying a home or refinancing right now?
Great question, Constantine. I'll start off with a little bit of humor. When the Federal Reserve dropped their funds rate to, was it 0, 5 or 6 weeks ago?
Yeah.
It was around, so two things happened. I got probably dozens of phone calls asking for the borrowers that I just closed if they could get 0% on their interest rate, which was kind of funny to me. I mean, I have to give it to them. You know, you don't know unless you ask, right? You kick yourself in the foot. And then, you know, people that are going into the process or new to the process want to know if they're going to get 0% on their interest rate. So I posted this on my Facebook, and you guys know this, but you know, the federal funds rate is, I don't know the exact term, but I think it's like the rate that banks borrow from other banks, how, you know, where they're getting their funding from the Federal Reserve, stuff like that. It has nothing to do with mortgage pricing. Mortgage pricing traditionally, throughout my whole career, we've always looked to the 10-year Treasury, and mortgage-backed securities have always followed the 10-year Treasury. So, you know, even as of 2 months ago, if the 10-year Treasury is going down, it's a good indicator that the mortgage-backed securities are going to follow. If the 10-year Treasury is going to go up, it's a good indicator that, you know, pricing is going to increase and mortgage-backed securities are going to increase as well. So what started to happen towards the end of January, beginning of February of this year, the 10-year Treasury was taking a beating. I mean, it was dropping basis points every single day. I don't even know what it's at right now. It's probably still under 1%. So it began to look like we were going to start this huge refinance boom in towards you know, the middle of February. You know, pricing was getting good. You'd had banks that would follow suit quickly as the 10-year Treasury was dropped, making interest rates the lowest I've seen since I started. And I was getting a lot of calls for refinances. But what happened was, as this was unfolding on the back end, COVID-19 was becoming more and more of a thing. The first initial impact starting in the beginning of March. So, you know, we're about 8 weeks ago now. We're starting to become a thing with lenders. They're starting to see, you know, the markets shake up. They're starting to see the impacts of people starting to lose their jobs. They're starting to see some of these shutdowns and things of that nature. So banks, in turn, even though the stock market's down, even though the 10-year Treasury is under 1 point, it looks like we should have 1% mortgage interest rates. Banks didn't know what to do for this period of time. So what they did is they adjusted pricing for volume. They adjusted pricing for the unknown. They didn't know how to price. Like, there's a 2 to 3 week period where you know, what the week before I could get 3% on an FHA loan, I couldn't get at 4% on an FHA loan without paying 2 or 3 points. Like, they really just wanted to pause and stop the whole process. So what we saw was mortgage-backed securities uncoupled from the 10-year Treasury, and that's the first time it's happened, at least in my career. And I, you know, listening to some people on YouTube or on the news, I think it's one of the first times it might have happened in history. Don't quote me on that, because usually the mortgage-backed securities follow the 10-year Treasury. They uncoupled, and no one has seen this. No one knew how to react, but it caused some confusion and, you know, market hysteria for a while in pricing. So, you know, here we are. It's May 1st today, and pricing has, you know, banks have gotten a hold on things. Things have become more stable, and it's come back into, you know, it's not as low as we were as in February, that peak time where it was as like the ultimate low, but rates are really good right now. It's still a good time to buy a house if you're qualified, if you're looking. I know I might have scared people earlier, but it is a good time to buy a house. You still can buy a house. I still have loan programs for you, and we can get you. We can get you into the house that you guys want.
So Matt, what you're saying is that the 10-year Treasury and the rate that people would get on their mortgage don't trade in lockstep. So if you see them continue to fall, like you said, they've kind of decoupled. It doesn't necessarily mean the rates will go lower. There's an implied risk that the banks have, the lenders have, of default, et cetera. So they factor that into pricing. Talk about some of the
they're getting
products.
crushed on the back end right now with just to touch on that with rates. I mean, there's a reason that all this is happening. So I mentioned early payoffs, and I mentioned, there's a quick refi boom. So if you're a lender and you just say you have, you have $100 million in assets and you had this massive refinance boom for 3 or 4 days or even a week when, the 10-year Treasury dipped, you had most of these lenders fall for a few days with great pricing. It started to refinance boom. So you had a lot of early payoffs. You had, a lot, if I had $100 million in loans in my loan portfolio and I just lost 33% of them because people wanted to refinance, I was counting on this income. I was counting on this revenue, this portfolio of loans for, my balance sheets and how I operate. Well, if I just lost, 20, 30% of them because of a refinance, well, that's a huge hit. These were loans that they were considering having on their books for, I don't know the algorithms that they use, but most people get a 30-year note. And if you've got a 30-year note on your books and you plan on receiving payments and interest for these, at least for 10, 15, 12 years, I mean, no one keeps a mortgage for 30 years these days. They either refinance or move or sell. But, they know how long to expect a normal loan to stay on their books. Then you're hit with all these early payment or first payment defaults as well. This is why they did what they did for pricing. So, they've lost, and this is why I mentioned earlier why lenders, some of them aren't lending money anymore. I mean, if I was a lender and I had $100 million in assets and I just lost half of my loan portfolio because of borrowers not making their payments, my loans getting rejected back to me, refinances and early payoffs. I mean, this, they can't handle the financial stress. It's, haven't seen this since 2008, but this part's different because it's a health issue. It has nothing to do with the banks. The banks are at fault inevitably. 2008, we all know that, but this has nothing to do with them right now.
Sure.
Yeah, I'm glad you mentioned the refinance because when Dave and I manage assets, to tie this into the investment piece, that's the risk that we assume as well. So there could be some repayment, and mortgage-backed securities year to date is still positive, around 2.5%. One of the few asset classes is still positive. It's not a huge return, but when we look at fixed income, and fixed income is a part of what we do for our clients, and people still need income. When you're retired, just because of COVID, doesn't mean that all your problems go away. No, you still need income. Those folks are still seeking a stable way to get a paycheck every month. And fixed income is a part of that. So we're really selective in the bonds we choose and the fixed income asset classes. You look at things like floating rate. I don't think interest rates are going up for a while. Could be some time. So and we also have to be careful and conscious of the fixed income portfolio with respect to corporate bonds. You look at high yield. In high yield right now, if you're into those asset classes, you mentioned failed payments, you look at private real estate, you look at even commercial real estate. Those folks are not paying. They're big tenants. That's big checks that are lost each month. So I'm curious to see how that'll play out.
And from what I'm seeing too, Matt, is and I don't know how much it ties into what you do specifically, but just talking about real estate briefly, is I'm hearing a lot of headwind about in the future, commercial real estate specifically can potentially be our next bubble as far as the market is concerned, because you have all of these people that now, based on COVID, you see a lot of people working from home, and I think a lot of businesses are going to realize, hey, we don't need to rent the 14th floor of XYZ building downtown because we could farm 70% of that and keep people home And then maybe now we need substantially smaller space where we don't need it in such a high expense rent zone, where you're going to see a lot more of that. And commercial real estate can be very profitable, or it can become very dangerous. And I think about locally, I was telling Constantine about this the other day, was Kodak in its heyday. If you look on Ridge Road, Ridgeway, all in that area up near Greece, you had warehouses out there that commercial real estate Kodak was renting for decades, and these people were making a fortune. But when Kodak went away or depleted from like 40,000 employees to 4,000 employees, 3,000 employees, all of these warehouses became empty and unusable because nobody needed that type of warehouse storage. So it can be a very lucrative sector, but it can also be very unstable and dangerous as well. And I do agree with that. I think long term, a future bubble we may be looking at is a commercial real estate bubble. So that's just my 2 cents, kind of correlating that to how things can kind of change with a pandemic like what we're facing right now.
Yeah, I mean, it's we haven't seen anything like this before, and it's very, be interested to see how things kind of play out. I mean, obviously I want everything to work out the best for everybody. I want everyone to stay healthy, but we really don't know. On a positive note, Const, you mentioned something just a few seconds ago. You said, I think rates aren't going to go up for a while. And I want to agree with you there. And I want to touch on that. I really think that rates are going to stay moderately low. I think that the mortgage industry, not specifically commercial, it could be commercial as well, but I think the mortgage industry and the retail industry, or the real estate industry market segment of the economy, I think that's going to be one of the things that's going to help bring the economy back out of COVID. I mean, we're, what do you do? $100 billion in loans every year. There's, I just think that we're going to be the industry to help bring everything back out of this. I think realtors are going to get back to work. People are going to still want to buy houses. People are edging to go back out there and doing it. And I think the banks and mortgage lending specifically is going to be, hopefully a good part of the cure to bringing the economy back. It's just a feeling that I have. I've listened to a lot of people on some podcasts, and I think, this wasn't our fault. We're just reacting to it to protect ourselves. But, as soon as we start, taking the brakes off of what we've been doing and opening things back up again, I really think we're going to be part of the resolve here for, everything
the recovery.
That's just the recovery. That's just my 2 cents. We'll see how it plays out. I mean, I hope.
Yeah, well, I'm going to be a little bit of a contrarian here, Matt. I agree with you in the short term. I think we're going to be in a very low interest rate environment. But I think 3 to 5 years from now, with all the money that we're kind of insurging into the economy, I think we're going to have we're going to go through an inflationary period that we haven't seen, like in our generation. I'm talking like the people on this conference call right now, where you're going to see interest rates. Like I always hear, my older clientele, and they're like, in the 80s, interest rates were at 18% for a CD, but mortgage rates were also 17, 16%, which is just astronomical to us. But I think that we're going to, and I'm not saying it's going to get that high, but I think that once this recovery happens and we come into the new world of where we are, because we're not going back to the way it was. It's just not reality anymore. But when we get stabilized in this new reality, and people do get back to work to whatever capacity that looks like, I do think eventually, and I'm going to say 3 to 5 years from now, we're going to start to begin to see inflation like we haven't seen in a long time. That's just my prediction, and we can kind of see how it pans out.
I hope so.
Well, we've already lowered the federal funds rate, so that, I mean, what's our stop for that? I don't know. There's people smarter than me that have to figure that out.
Above our pay grade.
All right, a couple last questions from Matt before we wrap up the show. We know you do mortgages. Are there any other lending products? You guys do refis, home equities, line of credit? I honestly don't know, and I'd love to hear. And I guess with that, before Dave asks you the last fun question, what does your ideal client look like? What's your perfect client look like right now?
So part one of that question, what do we offer? I do everything. and have a way to do everything. So we do conventional USDA, VA, 203K loans.
So this is all people buying houses, first
Yep.
mortgages. Okay.
We do. Every bank that I work with does refinances. So you can do your cash out refinance or limited or no cash out refinance, which means you're just getting a new rate and a new term. So I have all that. If you need a second mortgage, I have options for you as well. And then, what does my ideal client look like? Well, I don't want to sound corny, but any client is a client that I like to work with. But I really like working with first-time home buyers, someone that has an ear to hear, someone that's willing to listen and take my advice for, the experience that I have and what I've seen. I really like people that are excited to buy their new house. I mean, like I said, I have a product, I have a product or program for anyone. So whether, you're 550 credit score and I just got to get you a little bit higher, or you're an 800 credit score and well experienced, whether you're on your first job or you're getting ready to retire, I truly enjoy working with everybody, but I really like the people that, I can, develop some sort of rapport with and teach them some of the things that I've learned throughout the way and help them understand, why things are the way they are, especially right now. There's a whole bunch of questions like that. So just, I those are the type of people that I like to work with.
So pretty comprehensive. You guys do a little bit of everything. Dave, last question. Go ahead. Fire away with a fun question.
All right. Well, Matt, first of all, before I dive into that, I do want to have you on the show again in the near future, maybe sometime later this year or next year. I wanted to kind of go over just some questions I had about from a faith-based standpoint. How do you mix in, because obviously we know each other from church, how do you mix in your faith with your work? Like, how does that kind of role coincide? So that's something I kind of wanted to discuss today, but obviously we just had such a plethora of topics to talk about today. And then the second thing I wanted to cover was your illustrious bodybuilding career that we didn't have a chance to dive into today too.
Oh my
Future
God.
episodes. So here I have two questions for you. They're the most important questions we're going to ask you today. Your first question is, who is your favorite superhero and why?
My favorite superhero?
Yes, sir.
Oh my gosh.
Just go with your first reactions. Normally your truest.
Yeah, I was gonna say one of the Avengers. I just don't know which one. I like them all. I don't know. I'll go with Iron Man.
Iron Man?
Yeah.
Okay. Any reason? Just he's cool?
It was the first Marvel movie to come out. I don't know. I just liked them. I like the ability to be able to jump on a suit and fly around. I like them all. I like Hulk. It's hard to. I like the Avengers.
Okay.
All the Avengers.
You watched all the show, all the episodes, everything about the Avengers?
All of them.
Yeah. What a great series.
Or
man.
I could be Star-Lord too, because I think Chris Pratt has a hilarious sense of humor from Guardians of the Galaxy, and he kind of like his humor adds up with my humor and his mannerisms. I think it's very funny. So
Sure.
I could be him as well.
All right, I like it. And then the second most important question is, if you were an animal, which animal would you be and why?
I'd be a lion.
Lion.
I'd be a lion. I'd be the male, obviously, lion. And why? I grew up liking Lion King.
Thank you for clarifying that.
Yeah.
Thank you.
I think that Lion King was the first Disney movie that I saw as a kid growing up, and I just always liked lions and had this infatuation with lions, and I think they're really cool. So I'd be a lion.
I like it. Those are two great answers.
How about you?
Matt.
Simba, I love it. I love it, Simba.
Kant asked me on one of my first podcasts. I think I said like a bear or something. I forget.
Yeah,
It's been a while. Matt Merrick, ways to reach you, Matt. HausCapitalCorp.com. That's HAUS capitalcorp.com. Or you can email Matt at matt@housecapitalcorp.com, or give him a call, 585-509-6849. Matthew Merrick, thank you for your time. We appreciate you. We value your relationship, and we hope that you and your family stay healthy. Oh, and you have a little one coming next month, right?
June 19th. Dave. Thank you. And thanks, Con. Yeah.
Congratulations, Matt.
Thank you. Super nervous, but also super excited. First, it's my first child. We're having a girl, and we're looking forward to be parents, both me and my wife. So, we appreciate you guys, Dave. I talked to you a little bit more than Con. Doesn't matter. I appreciate Monarch Wealth Management and everything that you guys have done for me ever since I've been a client. And I thank you for having me.
Yeah, it was a joy, man. We'll talk to you soon. God bless you guys, and have a great weekend, okay?
All right, guys. Thanks.
You've been listening to PennyWise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is PennyWise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, SIPC.